Welcome back to Sky's the Limit podcast. I'm your host, Mike Doherty, and today we have an awesome guest, Rick Bush, located here in West Hartford, Connecticut. Rick Bush owns a number of companies, namely a construction company, a property management company, and a brokerage here in Connecticut, R&M Property Management and Bush Real Estate. He's the owner of 42 rental properties, and not only that, he also manages 300 units. He's currently the president of the Connecticut Association of Real Estate Investors. They have monthly meetings. He's been the president there for 12 years. He's also the treasurer of the Connecticut Coalition of Property Owners. So he is all things real estate. Very happy to have him on here on the podcast. He's a buy and hold investor. He bought his first property in 1996, and he's going to go in and tell us his story. So with that, Rick, welcome.
Thanks, Michael. I'm happy to be here today. This is one of my favorite subjects to talk about. So looking forward to it.
Yeah. So how did you, so you got 42 units now. Let's hear about how you got started in real estate investing.
It's a funny story. I'm glad to be able to share it. 1999, I'm living in a 400 square foot condo with my brother. It's a one bedroom. One of us has the bed, one of us has the couch, and we're trying to figure out what to do with our lives. And, we would stay up late because we were young and single and, whatever. So there was this guy named Carlton Sheets, who some of the older people may know, but he was one of those late night guys who's like, you can buy property with no money down. And so we're like, my brother and I went into my kitchen. We started saying, what are we going to do with our lives? We looked at each other. We said, hey, let's become real estate investors. We shook hands and we became real estate investors. And we're like, we're going to do it. So we ordered this online, this thing on the TV. There was no even internet at that point. And, we got the VHS tapes and the CDs. And, we listened to them. And what we realized was that real estate investing, there's no secrets to it. There's not some trick or something that's hard to understand. It's really just basic stuff. And this video that we watched was really sort of basic. And we're like, wait a minute, we can do that. So we printed business cards and we just started telling everybody that we were real estate investors. That's it, And I'll never, ever forget our first deal. It was really an unbelievable deal. We were working for a woman named Norma Wolf, who, God rest her soul, is a fantastic lady. And we're painting her kitchen, and my brother comes in and we start talking to her, and she's like, so, we're like, yeah, well, we're real estate investors. And we didn't own anything at this point. We hadn't bought a property. We didn't know anything about anything. And she's like, well, I've got this 3-family house. I'll sell you for what's left on the mortgage. And we're like, okay, sounds great. We don't know. We're like, what town is it in? She's like, oh, it's in West Hartford. And we're like, oh, that's great. So, and we're like, how much is left on the mortgage? And she's like, well, I don't really know. Let me call my bank and we'll get them in touch. So we end up, going through the process with her and her bank. It turns out that she owed $108,000 and that her son had bought it and had unfortunately passed away, and she inherited it, and it needed a ton of work. And I owned a construction company, so I wasn't afraid of work. And so we negotiated with the bank, and they basically said it's an assumable mortgage. All you have to do is sign right here and pay 1% down. So we wrote a check for like $1,800 or $108. Yeah. And we assumed the mortgage and we closed the property. We're like, we didn't even know what we were doing. The best part about it was, again, something we didn't realize at the time, was that we closed on the last day of the month. And at the closing, we got $3,000 in security deposits. And the very next day, we got $3,000 in rent. So with the assumable cost, all the closing costs with the attorneys, we actually just signed our name and got a property. And
That's amazing.
That was our first property. I mean, I don't know if deals like that still happen, but we still own it. We still own it. It's obviously done very well for us, and it was the cornerstone of our career at this point. So, and
just like that, overnight, you're now actually a real estate investor.
And then we became real estate investors. Yeah.
So that was the late 90s.
That was 99.
Okay.
I bought my condo before that. 96 was my first property.
But you were owner occupant on the condo, right?
Correct.
Do you still own that condo today? Do you rent it out or do you sell it?
I did sell that property. I did sell that. I made about 400% on it and sold it and used the money to buy other things.
Wow,
So
home run. Like, good
yeah,
for you. So
yeah.
you acquired the how many units was it again in West Hartford?
That was a
Two or three?
three
Three
family.
family. So you
Yeah.
acquired the three family, very little down, pretty much made money day one through the security deposits and the rent coming in the next month. That house must be paid off now, I assume, right?
So that because we were young and because that was our first property, we actually used that to lever ourselves to be able to buy more properties. And that's the one thing I talk to younger investors about is depending on how young you are and how much time you have on your side, you really want to leverage yourself as much as you can within as long as you're taking reasonable risks when you're young because that will pay off later on. So
Right. So
no, we
what did
actually
you
still have a mortgage on it. Yeah.
so did you do a cash out refinance? Did you put a home equity line of credit on it? Would you do? How'd you gain access to that equity you had there?
Yep. Actually, we actually refinanced that house. I think three times because the first time we refinanced it was right away. We took $50,000 in cash, and my brother bought a new car, and I paid off some other debt. We financed it a year later because the prices had started to go up at that point. We took 100,000. We did a cash out refi, and we took another $100,000 in cash, and we used that to buy our second property. And in West
Yeah.
Hartford, another three family.
So
Yeah.
just for the listeners, a cash out refinance, what Rick did was let's just say he owed $100,000 left on this mortgage. He fixed it up. He made it nice. He got the renters in there, made their units nice, and he went to a new bank and he said, "Hey, listen, I have an awesome three family. It's cash flowing. I know I have really good equity in it. I mean, maybe at the time, would you do that cash out a couple years later? I'm just trying to picture when the market was."
Yeah, back in '99, 2000, the regulations were a lot less strict
Okay.
than they are now. So we did it within a year of each
So
other.
what was that property worth when you did that cash out refinance? What was the ARV?
It was over 200, over 200,
Okay.
probably 225, I think.
So
Two,
they were willing, so you went to a new bank and they were willing to give you a new loan to value of probably 75% of the appraised value. So if it appraised at 225, maybe 250, they were probably willing to give you a loan 75% of that, I
yeah,
assume.
I recall something along those lines, but I know we cashed out for just under $100,000.
And that's what's so powerful about leverage and real estate investing in general is that you can tap into that equity called sweat equity you created through construction and management. And what's beautiful about a cash out in particular is it's tax-free money. So you were able to pull out 25, 50, maybe up to 100 grand, and use that to go buy more real estate. And that's the golden nugget right there. I mean, that's a beautiful thing.
100%. I mean, that's what anybody who's been in real estate for the last 20 years has been able to really do well at because the prices have been going up pretty consistently. And as soon as you are able to build sweat equity, because we're in construction, we go in and fix it, put paint, new windows, new kitchens, new bathrooms, get good tenants. The value, the equity just goes up. I mean, it's in a rising market. So for us, it was just a home run, and yeah, basically tax-free money that we can
Yeah.
just put right into a new investment. It's great.
So, for a new real estate investor entering the market today, let's just call it in New England here, what would you recommend? Do you recommend someone to go buy a house hack, buy a 2 to 4 unit house hack, live in one unit, rent out the other, more turnkey property, or would you recommend someone to go buy something that needs a little bit of value add and do that that BRRRR method that everyone talks about, the buy, renovate, rent out, refinance, repeat. So what do you recommend for a first time home buyer buying a 2 to 4 unit multifamily? They want to use a low down loan, do something more turnkey or sweat equity value add.
So those are both good strategies. My recommendation would really depend on the person's financial situation, how old they are. But to speak to both of them, an owner occupied property with a lower down payment is a fantastic way to go if you can get into it. Buying a 2 or 3 or 4 unit building, living in one unit, and just getting in for a low down payment in and of itself, as long as the cash flow is positive, it's just a great strategy. And turnkey is even better. That's really hard to find these days. So that's sort of the holy grail. You buy a
I know.
property that you could live in, that's a turnkey, that makes money. It's a no-brainer.
So
Absolutely, 100% do it.
yeah,
We
you
only did
can't.
that about 4 or 5 times. So in
Right.
my career, my brother and I would go from he'd buy one, then I'd buy one, and we just kept flipping into owner occupieds for a long time until we couldn't do it anymore, until we had a critical mass. But the BRRR strategy is by far the most professional way to do it if you have cash, if you have money, if you're not strapped for down payment. That's so I was doing that before it even had a name. We
Right.
started doing that right away. We'd buy a property that was distressed. We'd go in and immediately we would do all of the things that needed to be done to fix it up. And we would do it ourselves. So we would immediately be building a lot of sweat equity. Um, the ideal scenario, if you can, which is not a lot of people can do it, is to pay cash for a property, because then you don't have any carrying costs, and you can go in and you can do all the renovation repairs, get good tenants into place, and then you have this as repaired value, which is generally significantly more than you paid for it. Then you do a cash out refi, and and you're off to the races. So they're both fantastic strategies. I don't know if I fully answered your question,
No,
but
no. I think if you to your point, if you have the capital, go for the value add, because you'll be able to reuse that capital you originally had.
yeah,
I get this question a lot. I'm a local agent here in Connecticut, and I work with a lot of first time home buyers, and people always want to utilize their low down loan, whether it's FHA or it's 5% down conventional, which FHA, as we both know, has standards for the condition of the property. You really can't look for anything that has a lot of defects, peeling paint. It has to be operational and good condition. But with that, I always say to people, go based on your comfort level. It's a lot to buy your first home. There's a lot of moving parts, but the house isn't going to fall down the day you buy it, right? So kind of get that notion out of your head. If you have enough background and you feel comfortable, maybe you swing your own hammer so you can do your own work, then maybe go for something that requires a little sweat equity. But don't overwhelm yourself. Maybe look for something a little bit more turnkey. Maybe a couple of the units are already rented out. You don't have to go through the whole leasing process. You will eventually, as a landlord, have to go through the whole leasing process, and you will have to, maybe paint some walls or fix some P traps here and there. But ultimately, if you can buy something a little bit more turnkey, you won't get yourself into this idea that like real estate is so hard to come by and I have to do all these things. I have to fix up the property. I have to get a loan and I have to be a manager now. So maybe just buy something a little bit more turnkey, get your feet wet, figure it out, and then learn how to become a landlord. And then maybe for your second property, you go buy something that needs a little bit more work. And that way you be just that much more comfortable.
well, let me speak directly to that. If anybody who's listening has no construction experience and they don't have good contacts with contractors, it's very, very difficult to buy a property that needs work. You really could get overwhelmed pretty quickly, and you could spend a lot more money on renovations and repairs than they may be worth, if you get, especially if you don't know what you're getting yourself into. Um, my specific recommendation for anybody who's looking at any property that needs work is that you have an agent or a broker who you're working with who understands deferred maintenance, because there's nothing
Right.
that can really damage a first time home buyer more than getting into something that really had a lot of unknowns and unforeseen renovations and repairs that are big ticket items. So, a good broker is invaluable in that situation. And I, I've dealt with a lot of people who said, "Oh yeah, my agent recommended I buy this," and I was like, "Oh great, what are their qualifications? They work with investors or they work with homeowners." "Oh yeah, it's a friend of my wife, and yeah, she's a teacher, but she does this, in the summer." I'm not taking anything away from that type of agent. They're good people. But if you're going to be an investor, you really need to have a broker who understands investing and who can really point
Yeah.
out all of the deferred maintenance items.
100%. It's like working with a financial advisor who doesn't manage his own portfolio, or working with hiring a contractor whose house is in shambles. It just doesn't make sense. Why would I go hire a contractor who can't even fix up his own house? Why would I hire an agent unless they're very close to me who maybe doesn't own an investment property themselves. I mean, they're talking the talk, but they can't walk the walk. There's a lot of agents, and you can empathize with this too. There's a lot of agents we come across that are preaching, oh, invest in this. This is how you do this, but they've never bought a rental property before. How can you possibly know that? I mean, you can read books, listen to podcasts like this, but I think firsthand experience is everything, and us coming from the agent world can surely shed a lot of light on that.
Yeah, 100%.
So you bought that first triplex in West Hartford, Connecticut through the loan assumption. You added the value. You did a cash out refinance. What's your next purchase?
So the next purchase it was another 3-family in West Hartford, and just to clarify as well, most of my purchases were not listed on MLS when I started working. These were all deals that I came across because I was just out there marketing myself. I was just telling everybody I was an investor, letting people know I was available to buy properties. And if you do that, you start to accrete. You start to accrete deals. They come to you because you're making it happen. So the next deal was a friend of mine who lived in an apartment. She called me up and she was like, "Oh my gosh, I have to move." I'm like, "Oh, why do you have to move?" She's like, "Well, the owner's selling the property." I was like, "Really? Well, maybe I'll buy it and you could stay." And we went over, and they wanted to try to do a for sale by owner, and I went over. I met with them. They were very nice. The house needed a little bit of work, but I did the walkthrough. I ran my numbers, and at the time, I was willing to pay $175,000 for this 3-family in West Hartford, which was in 2001, which seems unfairly low at this point, but it was great. Yeah. And so I did the walkthrough with them, and they were lovely people. Their mom had passed away, and they had the property. So I said, "Well, I'm definitely interested. What are you looking to get for the property?" And they said, "Well, would you be willing to pay 169?" And I already know that 175 was my number. And I don't even know what I was thinking. I was like, 169, I'll give you 171. And I just offered, I just offered them $2,000 more than they wanted. And they were like, okay. And next thing you know, I had my second property. And
how many units was that?
3-family also.
Another 3-family. Okay. In what town again?
West Hartford. So most of my holdings were in West Hartford.
Wow. So now you have 2 3-families in arguably one of the best towns in Connecticut. Do you still own that one today?
Oh, yeah.
Nice. Yeah. Well done. And did you also leverage that one?
I believe we did. Yeah, I believe we did. Yeah, a couple times.
So your portfolio of 42 units is a combination of 2 to 4 units. Do you have any commercial properties in there?
So 1 to 3, I like to say 1 to 3 units. Because in West Hartford, I don't own any 4-unit residentials, just 1 to 3. So condos, single families, 2 families, and 3 families.
Perfect.
And right now we are concentrated in West Hartford. We did branch out. We did some East Hartford and some New Britain, but we recently did 1031 exchanges and got rid of our outliers, and now we focus everything in West Hartford.
Awesome.
But to answer the question, we do own our office building. Which is nice. It was a house back, many years ago, and it's now just a small office building. And each of the rooms we rent out to therapists and financial planners and tutors and stuff like that.
That's perfect.
Yeah. So and then we just in January this year bought the building right next door to our office. So we have 2 small little commercial buildings right on the corner of South Quaker and Farmington Avenue.
So you are essentially house hacking, or you're office hacking, because you obviously have your office. We do the same here. I'm in Farmington, and I have, it's a shared office building similar to yours, and I take over one of the offices, and I lease all the others out, and I do pay a rent to myself. So it's an expense for my agent business, and it's income for the rental property business. But essentially I'm leasing here for free because the mortgage is being paid down by all the other tenants, and I'd have to pay rent somewhere, so why not in my own place? It's a lovely thing, real estate.
It really is.
But you hit on something before I kind of want to bring back. And when you first got started in real estate investing, you told everyone what you're looking for, what you're looking to do, what you're looking to accomplish. I'm a real estate investor. If you have a deal, send it my way. There's so many people that I speak to on a daily basis where, oh, Mike, how do you get a good deal? Where do you find a good deal? So I'm like, let me ask you, who are you telling that? Do you tell your friends and family that you're real estate investors? Like, who knows that what you're trying to accomplish? Well, if it comes up in conversation, well, why don't you tell everyone? Why don't you make a Facebook post and say, hey, I'm a local real estate investor. Here's my market. Here's my budget. Is anyone looking to sell anything in this criteria? You'd be surprised what you'd find out. Also, I asked them, how many offers have you made? It's free to write an offer. It's free to go look at a house. How many houses have you gone and seen? It's free to hire an agent, especially as a buyer. Doesn't I mean, at least it was. um, we'll see what the new NAR changes happen, but it's free to write an offer. It truly is. Write an offer 30-40% under the asking price. You may not get it. You probably not get 8 out of the 10 of them, but you never know unless you write the offer. So, you got to put in the effort, and you'll eventually see the rewards afterwards. But I think you just tell everyone what you're looking to do.
There's really no other way to do it. I mean, if you're going to be a real estate investor, you're not going to be very successful if you're just looking on MLS, because everybody's looking on MLS. You need to make deals happen. You need to shake the trees. You need to do whatever it takes to let people know that you're out there. And there's, I have to say, almost all of the properties I own, I bought that way. I mean, I think I maybe have so I own 19 properties, total of 42 units. And I think maybe 2 or 3, maybe I bought on MLS. Maybe, everything else was word of mouth. And I'll tell you, the best people to talk to are the neighbors of properties you already own. Right? I mean,
That's a good one.
I shoveled my neighbor's driveway for 19 years before he sold me his property. I would go over, hey, Tony, let me shovel your driveway. Okay, Rick, all right. Because I had a plow. I was doing mine anyway, and I had to back up in his driveway to shovel mine. So I just figured I'd plow it for him. And finally, I bought it just this year.
No way.
Yeah. Another 3 family.
I know that. I'll say another 3 family. Let me guess. West Hartford, Connecticut.
Yeah. So that's kind of my specialty. That's kind of what I do. It's just my sweet spot. I know them really well. I know how to fix everything. So it really makes sense for me. And I'll tell you, I like to call them my little monopolies, because, you play Monopoly, you get 3 properties in a row. And the very first property that I told you about at the beginning of the podcast, I knew, the house on the left, and I knew the house on the right, and they were 2 older women. And I would always be very friendly, and I would help them shovel their driveway or cut their lawn or carry their groceries or whatever, just because I'm generally a good guy in general. But, I obviously wanted to let them know that I was there and I was willing to help them out. And the second house I bought in my first Monopoly was to the left of this one I bought in '99. The woman named Angie, she lived there for her entire life. Her entire family lived in that house since it was built. And no one had ever moved out. No one had ever cleaned, I think, in 100 years. And we bought that property. So I bought the first one I bought was '99. Then I bought the one next to it in 2009. And then I bought the one on the other side in 2019. So it took me, 10 years in between each of those purchases, dealing with the families, making friends, being nice, just being neighborly. And when they went to sell the property, I was the first guy that go, hey, Rick, we're going to sell the property. Are you interested? And I said, yes, I am. Let's come to a deal, and let's make it fair for both of us. And so now I've actually named the 3 houses. The first one's Norma. The other one is Angie, and the other one is Helen. So I have my 3 houses, Norma, Angie, and Helen, all right next door to each other.
And for all the Monopoly fans out there, where on the Monopoly board would you say your properties land? Are they St. James, Mediterranean, Marvin Gardens, Atlantic? Where are we at?
So I like to call that my first one is Oriental, Vermont.
Okay. So in the blues.
The blues. And then I actually just got my second Monopoly in this April. So I have 3 in a row. And that one is probably, like New York and Tennessee and
high oranges. Nice.
Yeah.
Very good.
Yeah,
that's awesome. Because you have to think, if you own a boardwalk or park place, are you really cash flowing that well? Some of these, I guess if you buy right and you got in early enough, then maybe. But, I think of like some of these brownstones in New York City, and people are buying them for investment purposes, maybe for appreciation, but I just look at some of the numbers on CoStar, and I'm just like, how do you make any money? I mean, that's why I think you see a lot of, at least I work with a lot of New York buyers that, are fleeing out of the Brooklyn and in the Manhattan area, and they're buying here in Connecticut. Work with a lot of them. So, but yeah, no, that's awesome. Congrats on all your success so far, and um, you haven't stopped. Yeah, you're like, if a deal comes, you're gonna buy it, right?
Absolutely. I mean, I'm still looking. I'm not as well. In fact, I'm well. To be honest with you, we just started a whole new entity. Assembled a group of professionals that I've been working with for many years, and we're going to start a whole new process of looking for all sorts of different types of opportunities, from fix and flips to buy and hold to some syndication. We want to be able to provide value add to investors who know us and people who don't have the time to do it every day. So we've got a great team, 6 people on the team, and we're hoping to be able to leverage our experience into this market. It's a little bit difficult right now. I'm a little bit nervous about the market, but people always ask me, when's a good time to buy real estate? And I always say, when a good deal comes your way. It doesn't matter. I bought 3 properties in the last 6 months, which is in this market, for somebody like myself who's been very conservative, that's a coup for me to be able to have found that many deals. And you do have to ask, and you do have to make offers. Just to give you an example of some opportunities that have presented themselves, and that would not have presented themselves if I didn't actually go out and make the offer. I had an investor who I was managing properties for, who had a bunch of condos, and they got an offer to sell 5 of them that were all in one building. And he actually had 6. So 5 in one building and 1 in a different complex on the other side of the town, other side of the city of Waterbury. And so I was the broker. I ended up selling the 5. And he came up to me after. He's like, "Hey, I've got this other one. I don't really know if I just want to own one." He's like, "Maybe I'll sell that too." And I said, "Well, I'd love to make an offer." So I looked up the comps. I did some market research on it. And I said to him, "Listen," I said, "it's probably worth about 140,000. I said, "But because of the rent, because of the amount of rental income you're getting, and right now I said, the most I'd be willing to pay is for 105. And he's like, "Yeah, fine. You know what? Write it up." I was like, "What?" He's like, "Yeah, write it up." And he sold me a $140,000 condo for 105,000, no brokerage commissions, nothing. It was just as is cash. And turned out that it was left over for me. I did a 1031 exchange, and I had about 75,000 left over. So I was able to put that right into this investment and defer 75,000 in capital gains. So it was just a home run, and it wouldn't have happened if I didn't ask him and talk about it.
No
So
brainer. Well done.
yeah,
Nice.
yeah,
It's just the networking. It's power of networking. And for those listening, 1031 exchange is when you sell a piece of real estate and you buy another like kind property, and you defer any capital gains you would otherwise have to pay to our lovely IRS here. Again, you're deferring them. They're not free, tax free. You're deferring it, so you're essentially kicking the can down the road. But there's a lot of unique, powerful ways you can ultimately, put it into a trust eventually, and maybe give it to your heirs or kids, and they'll enjoy a lowered cost basis.
yep. The stepped up
Eventually,
basis. Yeah,
yeah.
upon
So
someone's death, the property gets transferred to the estate at a stepped up basis. So if I paid $100,000 for a 3-family in 1999, and I carry it until my death, and it's worth $500,000 or more at that, whatever, it's probably worth that now. It transfers into the estate at that higher level, and then if the heirs sell it at 500,000, they pay 0 for capital gains. So
exactly, yeah, really, really powerful tool, 1031 exchanging. I'm actually doing one now. Selling we have a building in Middletown, Connecticut. It's a 40,000 square foot mixed use property. I don't know if I told you about this one last time we chatted, but it's under contract to be sold. And I did a 1031. I sold 2 properties to acquire this one. I did a 1031. And
Mhm.
so now if I didn't do a 1031, not only would I have to pay the capital gains from the 2 properties I sold originally, I would also pay capital gains from this third one. So I really need to find a replacement property. Otherwise, I will be paying our Uncle Sam quite a bit of money. But that's the nature of the beast.
Are you looking right now for that? I mean, is that what?
Yeah. Yep.
Have
We
you?
are.
Are you
We
under
have.
contract to sell, or have
We're
you
under
sold?
contract. We have not closed yet, so I still have time to identify replacement property, and then correct me if I'm wrong. It's 45 days to identify, 180 days to close.
I hope 90 days to identify.
Is it
Maybe
90 days? It might be 90 days to
it might be.
identify.
Yeah. but
45
yeah,
or
it's
90.
it's not a long time.
No, no, it's not. And yeah, so anyways, we're working on that right now. I still got about a month before this property closes, so we still got a little bit of time, but definitely looking for larger value add multifamily. So if you ever come across anything, here we
Well,
go
I mean,
networking.
do you want to share any financials over on your podcast? How much capital are you looking to deploy? Because I can.
So it'll be about $350,000 we need to deploy.
So
Yeah,
one thing I learned about 1031 exchanges is that you don't have to just deploy your profit. You have to deploy the total sale. So the cost of the sale. So on the properties, I sold two three families in East Hartford, and my gross sales were 720,000, but I only netted couple 250 or 300,000 in cash after it was all done. Actually, maybe a little bit more than that. But for the 1031 exchange, I had to actually buy 720,000. So even though,
interesting.
yeah, you have to replace both the equity and the debt total, the total sale. So even if you're only making 300,000 and you have that much cash to redeploy, but you sold the building for $1 million, you have to deploy $1 million. Otherwise, you're going to pay some form of capital gains. And I'm not an accountant, but that's the one
Yeah,
thing I did learn.
interesting. Okay, very good to know. Well, I'm glad we did this podcast then.
Yeah, yeah.
That's awesome. So, you formed this group, and is your goal to raise more like private capital to then invest their more like joint ventures, or are you doing full syndications?
We're gonna see what comes up. I mean, we're gonna raise capital. We're gonna look for partnerships, limited liability partnerships, LLCs, syndications. We're gonna kind of see what we'll base it on the per deal. Like if something comes across our desk, we'll figure out what's the best way to do it. There are things that we're gonna buy cash, get some people to come in with cash, do a renovation and resell. I like to say renovate and resell instead of flip because to me, flip is a dirty word because a lot of people don't do it right. So it really will depend on the deal. From a small condo to a 100 unit building, it'll depend. And we, because of the team we have assembled, we can handle quite a bit of diversity in the process. I think syndication is not really something I've done a lot of, so that would be a little bit of a learning process for me. I
Yeah.
know that's kind of the buzzword in a lot of these meetups that happen, and I think it's a lot harder than people think.
You know, I agree. It is harder. I mean, there's a lot of legality to it, but what kind of drives me nuts is you meet these investors like, oh, I own 1,500 units, I own 2,000 units. I'm like, do you? Do you actually own those units, or are they syndications, right? And it's like, I think people kind of throw out a high number, but for you, like you own 42 units. It's either you or maybe a partner. It's not some huge 40 people who all went in on 42 units and you're paying them their dividends. No, it's like you own that. I think that's way more impressive personally than syndicating a 100 unit apartment building. While that is hard, and I certainly haven't done that, and I don't plan to. But personally, I think that 42 units that you personally own and manage, that's pretty awesome.
Appreciate that. Thanks.
Yeah, yeah,
It's been a lifetime, and I do have part. My wife is my partner, and my brother is my partner, and I have a bunch that
yeah,
are on my own. But they're all I mean, I own them, so it is cool.
yeah. The challenge with syndications, and correct me if I'm wrong, is let's say you're you're offering a double digit return to your investors, maybe 10, 12% return or higher. A lot of times, in order to hit those returns, you have to have an exit strategy. And a lot of times it's to sell that asset. And obviously, as the GP, you make your money on the acquisition and the disposition when you purchase it and when you sell it. And so, do you see a lot of syndicators and the GPs of the syndicators who have maybe 10, 15% equity or 20% equity in the deal? Do you see a lot of them refinancing and actually paying off their investors and hitting those double digit returns? Or do they, in fact, have to sell it? Because ultimately, if your goal is to acquire more units, syndication is just another job. You're making your money on your acquisition and you're making money in your disposition, and you have a little bit of equity there, so you're getting paid out on that. But you're always turning. You're always turning. You always have to buy it and resell it in 3 to 5 years. But correct me if I'm wrong. Do you see people refinancing and still managing to pay off their investors?
So I think I see people doing both. In a rising market, when prices are going up as quickly as they have over the last 5 to 7 years, you can easily refi yourself into a great position. But I think a lot of people are selling. I think a lot of them are cashing out, and it becomes a job, right? Like
Right.
you're saying, and that is exactly the opposite of the strategy that I employ, and have
Exactly.
employed for my entire life. I am a buy and hold guy. I mean, I hate selling things. And you asked me, the most difficult question you asked me today was, did you sell that first condo? And it crushed me when I sold it. Like, I hate selling stuff because it's so hard to find them. It's so hard to fix them up, and it's so hard to get them nice and nice and so they're producing their highest and best use. They're fully functioning. They're fully performing as an asset. Why would you want to sell it? Why would you ever want to sell it? What are you going to do with the money? Pay capital gains tax, and where are you going to put the money? If you're going to for me, if I'm going to buy another property, that's one thing. But yeah, so I don't like the syndication model that is just a constant churn, constantly looking for properties going in. I mean, at this point, I'm closer to my retirement than I am to the entry point of my career, and I'm looking for residual income, and
Right.
that's what I teach. I mean, I've been doing this for a long time, and the strategy is just buy it, fix it, rent it, hold it, collect your money. If you're young, lever yourself as much as you can to get as many properties as you can, and just like you're saying, lather, rinse, and repeat. But don't sell. Don't sell them.
Right.
It's just eventually there'll be a time to sell. And I'd be honest with you, I'm the way that prices are these days, I'm kind of looking at selling some of my single families, just because I got some college educations to pay for.
Yep.
Um, but yeah, so the syndication markets, it's a tricky game, and anybody who's listening who wants to get into it really needs to kind of have a much more sophisticated understanding of the market trends, the interest rates, the macroeconomic perspective of the entire country, and it's just so much to know, and it's really not a place for beginning investors. I mean, I've been doing this
Yeah.
30 years and I've never done a syndication, so
Right.
uh, yeah.
Even like maybe a joint venture is once you own a couple properties, then maybe you do a couple joint ventures, which is maybe two, three, four people total, and then if that goes well, then maybe you look into. I mean, you got to hire. It depends if you're raising capital from the public or if it's just people It's like 503B, 503C, I think. You probably know more about that than I do, but one of them you have to register with the SEC, if I'm not mistaken, and hire an SEC attorney.
So I don't right now. We're going to look into that, but right now I don't do any of that stuff. It's just all
Yeah.
LLCs, limited liability
Okay.
companies, and you buy in with your equity partnership. Whatever you contribute or whatever you negotiate is as your percentage ownership. For me, that's the
Yeah.
easiest, simplest,
Simple.
best way,
Yep.
and it's fair. It's fair. It's safe. And then everyone gets a K1, and you just you do your profit and loss, and you send everybody a K1, and people are happy. And if you do it properly, it's really, I think, the best way to buy properties.
Yeah. No brainer.
No brainer.
So for those just getting started in real estate investing, you've been investing for the last 25 years. You have experience in all walks of real estate, from 1031 exchanges to cash out refinances to lenders to appraisals. I mean, the list goes on. What would be your one piece of advice to give someone just starting out now and wants to buy their first rental?
All right. So I'm glad you asked that question. And I honestly thought that maybe earlier on in this conversation, I may have had an opportunity to give you this answer, but I'm glad it came at this point. So give me a minute to give you this answer, because I've been thinking about it for about 30 years. Um, and so anybody who's just starting out, and when I do my monthly meetings, I say this all the time: buying real estate is like buying a winning lottery ticket. You just have to wait to cash it out, right? So if you buy a house for $400,000 and you have to put 25% down, you put down $100,000, and then you just wait. You wait for 30 years. And when you're done at 30 years, you're going to have $400,000. It's not really a negotiable mathematical equation. You pay off your mortgage, you may have to reinvest in a new roof or a new driveway, or you may have to do some renovations and repairs over time, but hopefully your cash flow will keep up. So, the other thing that I tell everybody, that when you buy real estate, you get paid 4 different ways. And I have an acronym. It's pretty simple. PAID, right? You get paid because there's no other opportunity, there's no other investment opportunity that gives you the type of returns that real estate does. So we'll go through it. When you every month you pay your principal payment on your mortgage, and that's the P, right? So you're collecting your rent, you're paying your bills, you're paying your mortgage, and every month you pay a small bit of principal. That's income to you. That's money in your bank every single month. It may not go in your pocket, but it goes into your asset increases the loan to value. So you're paying down the principal. The A is asset appreciation. Over time, your asset value generally increases. And I think that real estate is somewhere between 6 and 8% historically, with obviously some peaks and troughs along the way. So your asset's going to appreciate over time. I is the income from rental, right? So you should make sure that whenever you look at a property as a suitable investment for you, you have to make sure that it's actually going to give you positive cash flow. Enough where you're going to be able to make renovations and repairs and keep up with the lawn and the snow and the roof and the gutters and trees and driveways and painting and all the things that go along with maintaining a house. It's not a set it and forget it investment. It definitely requires some active participation. So real estate is not is definitely for somebody who wants a little bit of hands-on, right? So every month you should be making money. You should have income from your investment, right? So that's P, A, I. The last is D, is the depreciation. So the one thing that real estate investors generally don't take into consideration when they're buying their properties is that every year you get to write off 1/27.5 of your property. And in Connecticut, I think it may be federal, that you get to depreciate your property over 27.5 years. So if you paid $270,000 for the appreciated part of the property, the building, not the land, you'll get to deduct $10,000 every year from real income. So if you're in the 15% tax bracket, then you're going to make $1,500 in tax savings on that income. So if you take all four of those and you put them into a spreadsheet, you'll be able to realize that you're getting 4 separate revenue streams from your investment. You're able to lever yourself at 25%, so you can lever yourself 4 times. And over time, you're going to keep up with inflation. That's the most important thing that I tell everybody, is that when you buy real estate, you're keeping up with inflation. And if you understand the recent economic turmoil that we've gone through in the United States, you'll understand that real estate prices are not higher. The value of the dollar is lower. So something that seems to cost $400,000 that used to be $300,000 is because the value of the dollar has diminished, and that over the course of the last 3 to 5 years, we've had 7, 8, 9% inflation on an annualized basis, that your real estate will keep up with that increase. So that's a complicated answer, but I packed a lot into it. And anybody who unpacks what I just said and understands the value of how great an opportunity is to buy real estate, you're going to do well if you're the turtle, not the hare. Take your time, buy and hold, go slow, and be proud of the assets that you buy, maintain them well. Another thing I tell everybody, if you have a nice property that's well maintained, you're going to rent it faster for more money to a better qualified tenant. So you want to be proud of your properties, take care of them, be a good landlord, understand your rights as a landlord, because in Connecticut, there's a lot of legislation that's currently being put out there that trying to diminish landlords' capacity to make money. I'm not going to get into politics in this podcast. We could do a whole nother podcast on that at some point. But there's a lot. There's a lot. It's there's a lot. I have a lot of knowledge, and I've been doing this for a long time, and I'm really happy to work with young investors because I understand really how powerful and how valuable it is. My first year out of college, I made $17,300, but I bought a piece of real estate. Right? I'm embarrassed to admit how small amount of money I've made every year for my entire life. But because I was wise and because I deployed my assets in a responsible manner and I took advantage of the opportunities, my net worth has increased because of the investment decisions. So there's a
Yeah,
huge amount of
that's
power.
awesome. That's
Yep.
really, really good advice for anyone listening. So thank you. Thank you. That's awesome. And again, congrats on all your success and keep plugging away and we'll keep seeing each other in West Hartford and sharing deals and stories. And I remember when I first ran into you at the Brico, the restaurant, we were chatting and you're like, we were telling about different properties we own. I'm like, yeah, I had to sell. She's like, don't sell, don't sell. It's the, if you don't have to, don't sell. And I couldn't agree more. It's sometimes you have to get to a better opportunity you otherwise couldn't afford, and you do that 1031. But by far, do not sell and just keep adding to the portfolio, because eventually, think about it, if you bought one property a year for the next 30 years, you don't need to rely on Social Security. You don't need to rely on a pension. You don't need a form. That is your retirement right there. Just because you did one thing smart every year for the next 30 years. So yeah, no, it's really awesome stuff. So if our listeners want to learn more about you or find out more about you, where can they find you? And we'll tag everything in our show notes. But if you have a preferred contact method, or I know you teach real estate as well, so where can people learn more about you?
So I try to hide as much as possible.
Okay, you don't have to share it. You don't have to share it. I'll share what you want.
So so I do run a monthly investors meeting. It's the second Monday of every month at the Butterfly Restaurant in West Hartford on Farmington Avenue. We
Do you
start
guys
at
sing
6.
karaoke?
You can do karaoke, but we maybe at our Christmas party next year we'll have
Yeah,
karaoke.
love that
Um,
place.
yeah. So it we don't meet in the summer, and I try to keep the meetings small, so I don't really market it too much. But I mean, if you Google search me, I'm everywhere. I mean, I ran for some political office in town, so if you just Google search
Okay.
Rick Bush, you'll be easily able to find whatever you need to know.
Awesome. Well, I know you're a busy man, so we'll stop it there. But Rick, really appreciate your time. Thank you all for listening. Be sure to like and subscribe. You can find us on Spotify, Apple at Sky's the Limit. Real Estate Investing with Mike and Ryan. We're on YouTube. So really appreciate everyone's time, and thank you for listening. And thank you again, Rick. And we'll see you soon. We'll see you in town. Have a
Thanks,
good
Mike.
one.
Great,
All
great.
right. See you. Bye.
All right, bye.
Thank you for watching Sky's the Limit. We're always releasing new real estate content, so if there's something you want to hear, be sure to leave a comment. And don't forget to subscribe to our channel.